From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Good afternoon, welcome to the COB. A bit of a dour day, it has to be said. My name is Kyle Rodder. I'm here with Danny Akuye. And Danny, I don't know where we've closed in the ASX 200. We'll check the CBI 200 now. But it has to be said, one-way traffic really for the local bourse.
Yeah, totally. It looks like the ASX 200 is off by 93 points, 1.25%, although it will settle. It takes about 25 minutes, just about 7,357.
Yes, and we'll look across the sectors because, the weakness was broad-based, just like yesterday. I guess the strength was broad-based, but the financials in focus today, the banks all down. Actually, Commonwealth Bank down by 2%, so really slapped down. Its results are coming out next week as well. I wouldn't say it's because of that, but certainly going to keep in focus going into that event. But look, Westpac down almost 2%. NAB, ANZ both off, so I don't know as a sector overall, but certainly I would say the biggest weight on our market today.
Yeah, absolutely, because I'm just looking, materials is off only by about just over 1.2%. I don't know, we're going to cross to some of the other interest rate. Yeah, utilities.
Yeah, utilities was the other one.
Yeah, there was a downgrade to AGL today, which probably didn't help. You can see that's off by almost 5%. And that's probably really done a lot of the dragging. And information technology, did it buck the trend? It tried awfully hard, but seems to have didn't quite make it today.
Yeah,
that sector, it was green for a while, but it actually finished down in terms of the sectors.
Indeed. We'll get to the tech sector now and just have a look at that. It was, again, pushing into positive territory very briefly, but gave up the ghost by the end of the day's trade. And you can see all our favourites down today. WiseTech still above $86 though. That's a really modest pullback in the context of things. Tech has performed well over the last few months. But I look at the three themes now, and there were a few to, I guess, get across today. And my favourite, and I've called it Fitch Slap. What's happened to market. Fitch slap. Yeah, like the other slap that you can have that rhymes with Fitch, but Fitch slap. We, of course, had the Fitch Ratings agency downgrading US government debt. It seems to be a convenient way. A lot of the commentary I'm seeing across the wires just explaining the move in markets today is a convenient way of seizing upon the narrative and maybe selling out of risk a little bit off the back of that news.
Yeah, maybe. I mean, certainly if we're going to tie it into risk off, just look at the little Aussie battler, which is 65.75 against the US dollar. It's just continuing to fall. But yeah, it does look like that has been an excuse today. But also the big important one is the announcement in terms of how they're going to raise, the Treasury is going to raise their money. So whether they're going in the T-bill end of the market or looking towards the coupons in terms of the bond yield. So that is probably a potentially market moving event tomorrow.
Interesting. We'll keep an eye on that. And just in terms of the Aussie as well, and local markets, not that it's any kind of consolation or helped us much today. Priced out, of course, the moves, the prospect of future moves from the RBA, being priced out, and certainly a hike in the next few months not in the market at the moment either. So another reason why, of course, we've had the Aussie just going in the one direction, up close to 67 cents yesterday, now currently down at 65.76, like you said before, Danny. But let's get across some of the news of the day. BWP Trust has posted full year net profit of $114 million, down 1% on the previous corresponding period. So you can see there the final distribution, 9.27 cents per unit. And Mesoblast was in a trading halt today as well. That's pending an announcement on the US FDA's review of biologics license application resubmission for Remstemcel-L. Remstemcel-L. Sorry, I had to pronounce that out a little bit, but nevertheless, we're going to keep an eye on Mesoblast. Obviously, that thing can move when news comes through. As you can see there, that's a one-year chart. A few other news stories today. Hello World shares were on the rise, bucking the trend somewhat. Raised full year guidance, it's a $42 and $45 million. Interesting, because we've seen this from a number of those in the travel and leisure sector.
Absolutely,
some resilience there.
absolutely, and there certainly continue to be favourites. We spoke with Wilson's today, and they continue to like the travel stocks. So absolutely, but also there was quite a lot happening with Pilbara Minerals, because they've received board approval for construction of a demonstration plant to produce lithium products at its plant in Western Australia, and that is actually with Telix, and I spoke to the CEO with Telix as well today. So
brilliant. So that'll be on our platform, if not now, very, very soon. So if you're interested in that, you can watch that later on. Some C-suite changes too at Nine Entertainment. Matt Stanton as CFO and Strategy Officer. Maria Phillips departs the business. You talked about that AGL news a little earlier. The broker downgrade over at Macquarie sees, a high risk of disappointing earnings from the company, citing soft demand and falling underlying commodity prices. So the target price will be lowered to $11.43 from $11.59. So that's going to be certainly something to watch as we go into reporting period. So it was, in fact, Danny, our stock of the day, and we had Michael Wayne from Medallion Financial and Carl Capolingua from Think Markets sharing their view on AGL.
People feel that they need to be all in. So I'm going to buy this. It's going to be the best. And when it goes up and 10 times, I'm going to sell it. I think you're kind of then pegging yourself to the price more. What I prefer to do is, if I see something going up, I buy a little bit of it. I mean, I'd like to get in thirds. So if I normally invest $1,000, divide it by 3, I'll buy that amount to start off with. And if it goes down, okay, well, not the end of the world, I only bought a bit of it. If it starts to go up, then I'll add some and I'll add some. There's no real limit to how much I can add. So if you get those exponential moves like this, you can make a great deal of money. Today, this move, so just talking purely from a technical standpoint, I don't care what Macquarie Bank had to state. Honestly, I have no interest in their comments. But from a purely technical standpoint, what it does is it changes the demand-supply dynamics. And we have seen supply come into the market. And that's when I start to, bookends the buying, start to get out of it. And I won't get out of this all at once. And for the people that listen to me in my webinars or follow me on Twitter, we'll be talking about getting out of a third of what we have.
The reality is it's a company on a very low multiple. I think even now it's about 9 or 10 times earnings, and the earnings trajectory is picking up a lot. So that's always a sort of attractive dynamic. So if you get a good chart, you get a business that's sort of appearing to turn the corner, low valuation, strong earnings growth, then it does seem relatively attractive. However, we haven't pulled the trigger just because we are a little bit concerned about this whole peak energy prices that Macquarie does raise.
Okay, so a mixed
Differing
assessment of
views.
AGL, I suppose, and I guess those two gentlemen do see the world a little differently, but there you go, that's what makes a market. But let's get to our guest for the show today, and standing by is Mathan Somasundaram from Deep Data Analytics. Mathan, thank you so much for your time today. This Fitch news seemed to be enough to scuttle sentiment, or at least that's the story of the day. So should we be worried about the credit quality of the US government?
Look, it's all relative, isn't it? When you got Bank of Japan telling you that they are shadow hiking, and then they are buying bonds, and then they are shadow hiking, when you have that kind of world, US looks rock solid. Is the Fitch move substantial? Look, I think it's blatantly obvious, isn't it? We've got US budget is forecasting, I think it's about $1 to $2 trillion deficit for the next 10 years. Interest payment is nearly $1 trillion a year. So, do the basic maths. In the next 10 years, their $33 trillion debt will probably double on a compounding effect. So do they have problems on their budget? Hell yeah. Does that matter? Probably not. In this kind of environment, the one-eyed man is king in the land of the blind, and USA is still the dominant economy. Whatever the rating might be, they're still going to hold that exposure. I think the bigger worry is how much the political issue of these kind of, I suppose, weak fiscal standing kind of plays into the outlook of what the government can do over the next couple of years. I think that's the main risk. I think the Fitch one is good. I mean, I'm surprised because, I mean, in the GFC, nobody did anything when credit was actually really bad. And it's not as bad now. So in that context, I'm surprised, but I don't think it makes a huge difference.
Indeed. Nathan, what about the Treasury has come out and said they've got to raise, 1.8 trillion, almost 2 trillion, in the second half of the year. Eye-watering numbers. But tomorrow morning, they're going to dissect it for us and tell us about which part of the curve, like are we issuing more T-bills? Are we going up into the coupons? Is that potentially a market-moving event with the things like the 10-year Treasury yield going up, Treasuries selling off in response to all this money that needs to be raised?
Yeah, I suppose the $64 million question is how is the market going to absorb this? I mean, we know that there's a fair amount of debt coming, and the US Fed has to fund it somehow, and so there's going to be issuance that's going to play out. You had the debt ceiling that held it back, so you knew there was a catch-up. I mean, the 10-year yield has held quite well without going too far above 4%. So the question would be, will it break out or will it start to roll over again? So this is the big question, I suppose, as you're asking. Will the yield hang around here and then slide back, or will it keep rising? I don't think it can go too far because there's way too much debt, not just at government level, but at household level, corporate level. So if the yields go, I think 4.5%, 5%, I think something will break. And I think everyone knows that. So I think it's going to be managed around here. So it's going to be interesting to see how this plays out. These are things that we have not done. I'm not talking about, 70, 80 years of data, the kind of historical amount of debt that you carry. We've never seen any of these things. So nobody really knows. It's fantasy. When people say, "Oh, well, I've modeled this," no, you haven't. It's never happened before. We've never happened before, right? I mean, we've had in the last 70, 80 years, we've had one occasion for a decade where we had high inflation. We never had debt like this and high inflation at the same time. And it never happened around the world. So it's just amazing times. So nobody really knows, but I think the level of bond yields that can rise are substantially lower than what it used to be. So people say in the 80s we had 18% interest rate. There's zero chance that we can get to there in the current environment because we carry so much more debt and we have much bigger asset bubbles in property markets, etc. So there is limitation. So I think to answer in a rounded way to your question, it's going to be fascinating to see how far bond yields can go before it actually triggers something, because at the moment, the markets have held up phenomenally well, given that we are at 4% yield.
Let's see if we can dovetail into perhaps the banks, just because that was where the weakness was found today. We saw CBA off by 2%. Coming into earnings season, CBA, it will report in about a week's time. In fact, I think it's exactly a week. What do you think of financials in this environment? Because at least on a valuation basis, well, CBA certainly looks relatively rich. You could argue maybe the other big three are a little bit rich as well.
Yeah, our banking sector is quite unique. It's seen as relatively safe because everyone does anything they can to help property market, and that tends to flow into our banks. Our banks, actually, the majority of the trades are done by global guys, and it's used for the currency trade. So the fact that we've had a substantial pullback in the currency is the main factor that's weighing on the banks today, more than I think the result worry, because I think the results are mostly known. The banks will basically come out and say, it's a tough environment. Loan growth is lower. We're going to manage cost and we'll hold on to our NIM. And in those kind of things, I think it should be okay. But the reality is, as things roll over, things slow down, banks will do it tough. So we're probably near the peak. I mean, if you look at it over the last 20 years, really, apart from dividends, you only made money on CommBank. The other three banks didn't really do much. So in that context, I think the bank sector is probably near their peak. I think more downside than upside. But in the shorter term, I think the bigger risk is the global guys will keep selling if the currency keeps rolling over.
Yeah, fair enough. Going into reporting season, Nathan, are you a bit nervous about some sort of, a few surprises coming through, or do you think the companies have been pretty good with this confession season in the run-up to reporting earnings?
Yeah, it's a tricky one because the volatility is actually very low, but the moves in stocks when they come out, they're not small, they're big moves. So I expect volatility to be actually quite high. I'd say a pickup in volatility is due. We've actually been way too low. I think markets still get surprised. I mean, if you look at what's happening in mining stocks, the gold stocks come out first, and they generally have higher cost, and the market gets shocked, which is shocking because it's kind of the thematic. But then the other miners come through, and everyone still gets shocked, and it shocks me that everyone gets shocked. The thematics like retail, for example, you'll know that most of the main thematics are pretty similar. They're going to be talking about the same thing, cost management and so forth, and tough environment. But there's going to be winners. I think there are some sectors that are holding up well, and some are actually seeing better margins. I think the services sector is doing quite well, and you're seeing some increases. I mean, energy prices have started to pick up, food prices have picked up. So some of those sectors probably will report better than expected, and the market hasn't paid up for it. So I suspect there will be some big winners, but mostly I think the market is relatively well priced. So the upside in most of the major sectors, I think, pretty capped. But I think there's going to be some sectors that are going to really do well.
Martin, really appreciate the time, and thanks for coming on. It was entertaining as well as always informative. We'll do it again soon. Martin Somerson from Deep Data Analytics.
Thank you.
Okay, let's get a look at the leaders and laggards now, shall we? And just to see what
finished.
Promedicus. There we go. There was some news out there a couple of days ago, and I know
another contract they got.
That's right. Yeah, there you go. So still seeing some follow through there, despite the kind of broad and dour sell-off we've seen today. Breville Credit Corp may be bouncing back just a little bit because it got rinsed a few days ago.
Indeed.
ResMed reports,
finding some love.
Reports, I think, is it Friday or have I missed that? I've lost all track of time this week. But ResMed was due to report.
Yes. Tomorrow.
There you go. Okay, cool. So we'll keep an eye out for that tomorrow. Yep. Silver Lake Resources also up. The laggards, and there'll be a few of them. There were a few of them, and there will probably be a few big ones. I don't know what that's doing there. I think that's just the.
It looks like something's gone a little bit awry there, but definitely one we can trust is AGL, or 4.4%.
Yeah, and maybe
Capricorn Metals. I think the others will just let them go through to the keeper.
Yeah, I think we will. And it's only Wednesday. Let's get to the small caps now. Task and Dacian Gold. Nothing there that sort of jumps out to me as being
good performance though, in a pretty dour day on the market.
Indeed. And let's look at the laggards down the small cap space. Are we better off this time?
Aeris Resources down 28%. Fluence, I didn't have something out the other day. I think so, but anyway,
And when it gets outside the 200, maybe the 300, I'm pretty useless.
Yeah, indeed.
There we go. But anyway, they're on your screen there if they do relate to you. But let's look at the day ahead now, and what's coming up tonight, I should actually say, which is more than that, but actually not much more than that. It's the ADP unemployment figures coming out this evening. And on top of that too, we do have some earnings out of the United States.
There's a lot of earnings.
PayPal is in there.
Yep. So we've got heaps: Qualcomm, Shopify, PayPal, Equinix if you're into data centers, Mercado Libre if you like to go racy in South America. So quite a lot to say the least. Simon Property Group, that'll be interesting.
Yeah, and
DuPont is also out. Yeah, look, there's just so many.
Equity analysts, the DuPont.
What's it?
Favourite of any old equity analysts?
No. Albemarle's out also. So actually, people might be quite interested in terms of that one, how that goes in relation to our market.
Yeah, if they decide to throw another handful of cash at one of our miners or something like that, just another wad across the Pacific. Okay, so tomorrow it's a little bit quiet. We've got trade balance data, some local AGM, which is of course Computer Share. So there you go, something to look forward to in the next 24 hours time. But I dare say, Danny, that maybe we'll be just looking at whether this sell-off carries through into European and US trade.
Yeah,
US futures are down.
Yeah, US
0.5%.
futures are down, and also, the Aussie dollar again. It's just I'm watching it fall. It's 65, 67, and yes, the futures are down. And our market, the ASX 200, I'm getting down 96 points, or 1.29%. So pretty chunky sell-off today. All yesterday's gains erased.
Yeah, indeed. And investors don't seem to like life above 7,400. It doesn't seem to last too long, unfortunately. So we're back in that range now. But nevertheless, again, we'll see how we fare throughout the night's trade and pick things up tomorrow morning. In the meantime, if you do want to catch up on all the day's content, it's on our website and app. Otherwise, have a lovely evening. We'll see you tomorrow morning.